This Wednesday, after the closing bell, Microsoft is going to be reporting their earnings. Microsoft is up about 115% in the past 5 years. That outperforms the market, which is up about 94%. However, if you had been in Google and Oracle, you would be vastly, vastly outperforming not just Microsoft, but also the S&P 500. The two laggers here that we're looking at today are Salesforce, CRM, and Adobe. In this video, we're going to look at these 5 companies, and we're going to see what their scores are with the Interflame Finance scoring method, and we're going to see are there any steal deals in the market heading into Microsoft's earnings. If you are new to this channel, what we do is we score the companies that we're analyzing from -10 to +10. -10 is a garbage company, +10 is the best company in the world, and 0 is neutral. So we score them both on growth and safety metrics. So let's check out the growth metrics for these companies. First, we have Adobe. Adobe's coming in with very solid numbers. They have a PEG ratio of 1.0. Remember, we typically like PEGs under 2 to give any consideration. PEGs at 1 or under are fantastic. Forward PE coming in at a 12.1, and a 5-year forward PE coming in at 9.8 if they can grow their EPS 13% each year for the next 5 years. Now we have free cash flow yield, one of the best of the 5 companies we're looking at 8.0%. Next, we have Salesforce, also solid numbers. Debt to equity at 0.2, so that means that they don't have as much debt as they have equity. About 20% debt to their equity is what that means. And that means that they're well positioned for any downturn in the economy, any downturn in sales and revenue growth. Forward PE at a 17.7. That's also some of the best numbers we're seeing. Remember, the lower the better for forward PE. Profit margins at a 17.9%. 5-year forward PE coming in at a 13.2. Free cash flow yield at 6.0%. Google, also solid numbers. This is one of the best performing stocks in the past 5 years, as we saw. Debt to equity at 0.1, return on invested capital 30.7. PEG ratio getting close to 2, but still under 2, so we like to see that. We have Microsoft, EPS at 18.3%, and revenue growth also a very strong 15.3%. Debt to equity at 0.3, PEG ratio at 1.7. And Oracle, PEG ratio at 1.1, return on an equity about 70%, profit margins at 25.3%. However, we do see negative free cash flow yield, and we have a 5-year forward PE coming in at 9.4. So how do these rank? Well, we have Google coming in at a 5. Now remember, even though 0 is neutral, we typically like to choose companies that have scores of 5 or higher because we want to pick quality companies. So the fact of the matter is that when it comes to growth scores, the lowest score is a 5. That is fantastic news for all 5 of these companies. So Google is the lowest, tied with Oracle as well, also for a 5. Salesforce coming in at a 6.0. We have Microsoft coming in at a 6.5. And the top of the leaderboard is actually Adobe when it comes to growth metrics at a 7. Next, we do the same thing for safety. Adobe coming in with a PE ratio currently at 18.0. Return on assets, a fantastic 21.1%. Now, they don't pay a dividend, so therefore they have not grown their dividend. And so we have nothing to really report on the dividend front there. So that might affect Adobe's safety score. Salesforce, they do have a dividend yield at about 0.6%, dividend growth at 4%, and they've grown their dividend for 2 consecutive years. So that's good news. And a pretty decent payout ratio at 23.7%. So we would look at that number and see that they can probably still continue not just the dividend payouts, but possibly even dividend growth for the years to come. Debt to equity, again, solid at a 0.2. Google, a recent dividend payer. They are paying a dividend yield at 0.2%, so not much to speak of, but it is a relatively brand new thing for Google. Payout ratio coming in at just under 8%, so also very low, also very promising that they can not just maintain those dividends, but grow them as well. Microsoft, this is almost a dividend aristocrat at 20 years of dividend growth. Currently, they've grown their dividends 10.1%, dividend yield coming in just under 1%. And finally, Oracle. This is the highest dividend payer of all the companies. They're coming in at a 1.1% dividend yield, dividend growth at 25% in recent years, and years of dividend growth, 12%, or rather 12 consecutive years of dividend growth for that company as well. Kind of getting up there with the payout ratio at 38.4%. So if we look at the safety scores for these companies, Oracle's at the bottom at a 1.4, very likely because they have very low free cash flow yield. As a matter of fact, it's negative, and they don't have the strongest payout ratio. Next is Google at a 4.3. So we've seen a lot of growth with Google, but not offering a solid dividend, not really having solid numbers to report on their dividend growth is probably hurting Google in our scoring methodology. Salesforce coming in at a 5.7. So that's the first company that we see with a safety score over 5. Microsoft tied with Salesforce at 5.7, and Adobe coming in at a 7.1. If you get anything out of these videos and you like our content, please like this video and subscribe and tell your friends and family about the Interflame Finance methodology. Nothing that we say on this channel is financial advice. We're not telling you to buy, hold, or sell anything in your personal portfolios. Always do your own research and due diligence. Now, one thing that we like to do on this channel is not just score these companies, but make sure that we're getting a good deal. In the description of this video, you'll see links to different intrinsic value calculators. And those four are the PE ratios model, where I show you step by step how to build out models just like this that you can run on your Google Sheets account yourself if you agree or disagree with my numbers, or you just want to compute intrinsic values of other companies that we don't cover on this channel. You can do the PE ratios model. You can do the dividend discount model. Adobe doesn't pay a dividend, and so we don't consider that one for Adobe. We have a discounted cash flow model, and we have the Peter Lynch PEGI model based around his PEGI ratio. So check out the links in the description of this video to see how to build those out yourselves. These are absolutely crucial, important tools for any investor to make sure that not only are they investing in solid companies, but the prices of those companies are solid as well. So the lowest score today is Oracle coming in at a 3.2. Current share price is 177. We think intrinsically it's worth 193. That does give us a margin of safety of 8.2%. So not a solid average score, very low safety score, and a margin of safety that's not even double digits. So this might be something that we hold off on. Maybe Oracle something that we add if the price comes down. We would certainly buy Oracle if we had conviction in it. If the scores, the growth and the safety scores get higher, we'd probably consider buying it at 164 and buy heavily at 125. Again, if we had conviction. Now, what do the Wall Streeters say? Well, Wall Street sees about a 72 to 78% growth on average in Oracle stock in the coming year. The average price target is 306. It's currently trading for 177. The high estimate coming in at a $400 mark, and the low is basically the same at 175 as to where it's currently trading. The consensus is buy. Next, we have Google. We can see that the average score for Google, averaging growth and safety, is almost that 5. It's a 4.65. Intrinsically, we think that Google is worth 329. It's basically trading for that at 328. So really no margin of safety to speak of. However, if we had conviction in Google, if this is something that we wanted to add to our Interflame Finance portfolio, we would buy at 280 and we would buy very heavily at 214. Now, Wall Street thinks that, again, just like us, Google is fairly priced. They're saying an average price target of 325 in the next year. That's basically what Google is trading at right now at 328. The high estimate's coming in at 400 and the low estimate coming in at 190. So they see some downside for the more bearish analysts of Google. Google is still coming in at a strong buy. So do with that information what you will. But we think right now Google is fairly priced. Fantastic company to have owned for the past 5 years, but possibly not something that we will consider in the short term. Next up is Salesforce. Not only does Salesforce have an average score coming in over 5 at a 5.85, but they have a margin of safety coming in at 20%. So that is what we like to see. We're going to buy Salesforce at 242 if we have conviction, and we're going to buy very heavily at 185. Now, in terms of price target, Wall Street is especially bullish with Salesforce. So the low estimate is coming in just under its current share price at 221. However, the average consensus is 324. That would be about a 40% upside from here. The consensus is buy on Wall Street, but the high estimate coming in at 405, that is about a 78% increase from its current price. Now, Microsoft is the star of the video today. They are the ones that are reporting earnings Wednesday after closing bell. Currently, average score at a 6.1 and a margin of safety at 13.4%. Their current stock price is 466. We think intrinsically Microsoft should be trading at 538. We would certainly buy Microsoft if it falls under $457 and buy very heavily at 350 if we have conviction in Microsoft. Where do analysts see it? Well, Wall Street is much more bullish on Microsoft than our current numbers. On average, Wall Street sees between a 34 and 37% increase in the next year for Microsoft. High estimate coming in at 675. Even the low estimate coming in at 500. That implies a 7.31% increase from its current price. Currently a strong buy according to Wall Street. And finally, perhaps surprisingly to some, the top stock, the top company today is Adobe coming in at a score over 7, margin of safety of 42.4%. So the current stock price is 301. Based on our calculations in our intrinsic value models, we think that Adobe should be trading for 523. If we have conviction in Adobe, if this is something that we want to add to our portfolios, we would buy Adobe anything under 445, which it currently is, and we would buy very heavily anything under 340, which again, it currently is. Now, when it comes to Adobe, we are predicting 523. That is among the more bullish analysts that cover Adobe. The average price target is $420 for Adobe. That does imply about a 40% price increase from its current levels. However, sentiment on Wall Street is just over the buy mark. There's 9 analysts that say hold, 8 that say buy. So the average is very, very, very close to that hold mark. However, we do see that the price predictions for Adobe are very, very bullish, 40% in the next year on average. Again, we're saying that Adobe is possibly worth 523 based on our intrinsic value calculations. So let us know in the comments what you think. Are you buying or holding any of these companies or any of these that are on your watch list? Again, we appreciate you watching this video. Please feel free to like this video if you got anything out of it, share it with your friends, subscribe to the channel, tell your friends, tell your family, tell your mother-in-law about the Interflame Finance methodology. We will be making more frequent videos in the coming days as earnings season is upon us. So we will be looking at the companies that are going to report their Q4 earnings and see what that implies for the companies that we hold, the companies on our watch list, and anything else that we might want to buy, hold, or sell. So appreciate you watching. Thank you very much, and we'll see you in the next video.